Hi everyone, I'm Adam Thurgood, Managing Partner of Hightower Las Vegas, and I'm joined by our Director of Research, Raina Penilova, and we're excited to talk about the markets and the economy today.
Absolutely, Adam. Our client briefing is our quarterly deep dive in the economy and the markets. We'll be reviewing some important data points and discussing their market implications, and we'll also lay out how we're positioning our portfolios for what we believe is on the horizon. Now, for those of you who prefer something short and straight to the point, we also have our executive summary version, which you can find on our website.
Well, as we're kicking off our first ever client briefing in our new recording studio here in the office, it should be a fun 15-20 minutes. So why don't we jump right into it?
Yes, indeed.
So we thought we would title this presentation Rough Waters. And the reason is because last time our presentation was titled Cross Currents, where we thought the market and the economy were dealing with a lot of different cross currents. But today we think that the waters are a bit rougher, and we'll get into why a bit later. So what we're going to do today is we're going to talk about the current state of the economy. We'll talk about the banking stress that we've seen. I'm sure that's been top of mind for many people. We'll also assess the risk of recession. And then we'll discuss how we're positioning portfolios for what we see on the horizon. So when we look at the overall economy by looking at real GDP, you can see those wild swings from the COVID shutdown to the COVID reopening. But since that peak, we've trailed off quite a bit, and we've just recently bounced off the 1% line. Now, why does 1% matter? Well, if you look at the red bars that go back all the way from the 2008 recession back into the 1980s, those red bars signify recessions. You're going to see those red bars a lot in charts today. So just notice that when they're there, that's indicating a recession. And what we see when we look at real GDP is once real GDP growth falls below 1%, the risk of recession is quite high. Now, when we dig a little deeper and look under the hood of the economy, we can see a couple of different trends emerging. First of all, real PCE, real personal consumption, which is a big part of the economy, peaked out in late 2021 and has since trailed off and been more or less trending sideways for a time. It was actually on a 6-month smooth annualized basis negative for a lot of last year. We've recently ticked up to about 2%. But that's pretty weak compared to the 10-year average of roughly 5%. If we look at corporate profits, it's a similar story. We peaked out, now we're trailing off, the trend is becoming less significant. And when we look at industrial production, another important cyclical measure of the economy, we also have peaked and slowed, and on a 6-month smooth annualized basis, we're now actually in negative territory. So underneath the hood of the economy in terms of the coincident indicators, it's not as great as you might think. The job market remains quite strong, although we're starting to see some cracks there. But the economy looks like it's in a fairly weak position right now, but not yet in full contraction mode. And this is all happening with elevated inflation. We've seen some recent inflation numbers in the past couple of days. Inflation has come down a lot from those high points of last year. But on the consumer level, with CPI running at 4.9% and the Fed's favorite measure, core PCE, still above 4.5%, those are numbers well above the 2% target of the Fed. So the Fed remains very aggressive in its stance. And they've raised rates dramatically over the past couple of quarters. And what's happened is it's pushed up short-term treasury rates to the point where you can get over 5% now in a 3-month treasury. And that's dramatically better than what you're seeing in the bank, where you're getting maybe 0.4, 0.5%. So people are waking up to this and they're saying, well, why am I keeping my money in the bank when I can take it out and buy a treasury or a money market fund? And this is causing a liquidity crunch. Now, what do I mean by a liquidity crunch? Well, we're seeing actual bank deposits decline. And this is commercial bank deposits going back 50 years. And if you look at the bottom part of the chart, you can see that we're actually annualizing at a negative 6% rate. We've rarely seen this metric go into negative territory, and now we're in fairly significant negative territory. So what this all means is that these low deposit rates have caused deposit flight, and with a lag will cause tighter credit conditions and lower credit availability. And when we look at what's happening under the surface with credit availability, it doesn't look great. This is small business credit availability, declining quite rapidly. And when we look at how banks are feeling about giving new loans, which is measured by the percentage of banks that are tightening lending standards, we can see that it doesn't matter if you're a large business or a small business, banks are tightening those conditions. And now we're seeing, close to 50% of banks say, no, we're going to be much more strict in how we provide loans to the community. This is going to play into the commercial real estate space in some form or fashion as well. Commercial real estate's an interesting beast. A lot of those loans are 3 to 7 years. A lot of them are sitting on regional bank balance sheets. And these loans are coming up for renewal at a time where we have higher rates, higher vacancy rates, and a much tighter willingness to lend from the banks in general. So that's going to create some potential credit problems for the people that own these commercial real estate properties. They will be problems. And then also for the banks that might have some credit exposure from those businesses that own these properties. And speaking of debt, we've got the debt ceiling on the horizon, and that could be a major sticking point, a major issue. So I will let you take it from here and tell us about the debt ceiling and what's happening with leading economic indicators.
Thanks, Adam. Indeed, the debt ceiling is a wild card for markets, fast approaching. In fact, some of the latest estimates estimate that the Treasury is going to run out of money as soon as June 1st. So it seems like politicians need to get their act together and do so really fast. Now, ultimately, we do believe that this is going to get resolved, but once that resolution is announced, it's probably going to be a little bit of a bittersweet for markets. Now, while it's going to be great news that we are avoiding default and will be able to pay our bills, it would also mean that the Treasury would now need to start drawing money away from the economy and the markets and applying even more pressure. And that's all happening at a time when we have leading indicators already slowing down quite considerably. Now, this is the leading indicator index, a combination of 10 different leading indicators, and it's now slowing down at a pace of 7.8% year over year. Now, that level of slowdown hasn't been seen outside of recessions in the past. If we like to look at some of the survey-based measures, we also have the Philadelphia Business Outlook survey. Here, they interview 135 CEOs on a variety of aspects of their business, and this measure is also declining quite significantly. Also, the ISM manufacturing new orders component we frequently cite in our client briefings. It's the Institute of Supply Management, and specifically if manufacturing businesses, what they project regarding their new orders. And a reading below 50 indicates a contraction ahead. Now, when we look at market-based indicators that are leading for the economy and the markets, we usually look towards the bond market. Now, today's indicator has a pretty difficult title to read and to wrap your head around, but it's actually very simple. Essentially, it's where the market expects the 3-month Treasury rate to be 18 months from now, minus the current 3-month Treasury rate. So the bond market expects the 3-month Treasury to be 2 full percentage points lower in 18 months from now. Now, why would that be? Well, it's because the economy is slowing down and the market expects the Fed to start cutting rates pretty soon. Now, it gets even more interesting when we add the S&P drawdowns to this measure. Now, the black dotted lines indicate when we see the bottom of that ratio, and the S&P 500 doesn't tend to bottom until after. If history is any guide, it would suggest that we haven't seen the worst of the drawdowns for the S&P 500 or U.S. stocks in that matter. So When we combine everything all together, we already talked about how we've seen quite a bit of stress in the economy already. While the coincident data shows that we're still in positive territory, we are slowing down. We do have a strong labor market, even though it's starting to weaken on the fringes a little bit. But most importantly, we have several different risks lurking underneath the surface, and inflation remains quite high. So we believe that that would prevent the Fed from quickly turning around, becoming accommodative, and saving the economy on time. So at this point, recession is becoming our base case. So if it's our base case, well, the next question is it already priced in the markets? Well, if we simply dig a little bit underneath the surface, we can see the analysts, for example, are projecting some moderate slowdowns in earnings for this quarter and next, but then they expect earnings and sales to recover quite nicely as soon as the end of this year or the beginning of next year. Now, if recession really does come to pass, we believe that that's quite unlikely, and they're going to be forced to revise their estimates lower. And in the process, of course, stock markets are probably going to suffer a little bit. Now, where can we be wrong? Well, in our previous client briefing, we discussed the Chinese reopening as a major theme for this year. Of course, China is the second largest economy in the world, and it has the potential to pull the global economy out of the doldrums if their recovery is indeed powerful. Now, here we have the Chinese credit impulse plotted together with the US PMIs, which are a gauge of US manufacturing production. And we can see that the Chinese credit impulse indeed leads US manufacturing production by about 9 to 12 months. So it remains to be seen how powerful their reopening is, and if it's going to be enough to help us avoid a recession. But overall, we do believe that we should be seeking safe harbor within our portfolio construction. And there are several ways we're doing that right now. First, we do think that finally we're getting paid to wait. Interest rates for treasuries are quite compelling right now. We've been raising some cash and parking it in treasuries. And in the meantime, we're building our pipeline with companies that we believe are going to do quite well for the next business cycle, and waiting for better opportunities to basically deploy that cash. We also believe that gold is poised to do quite well in this environment. There's several tailwinds stacked in its favor. For instance, we all know how much geopolitical uncertainty there is right now in the world. There's many moving parts, and it looks like geopolitical stress is going to be here to stay for the time being. We also talked about how we expect economic weakness ahead, and since gold is considered a safe haven, usually it performs well in this environment. Also, if we do have economic weakness, interest rates are expected to head lower, and in the past that has also been positive for gold prices. And it looks like central banks are in agreement with us. On net basis, over the last year, they've increased their gold purchases by over 100%. And then when it comes to the market itself, if that's already reflected there, we could simply look at the ratio of the S&P 500 to gold ratio. We can see that the gold has already been outperforming the S&P 500 for the last several months. And in fact, now it's crossing below the 7-year moving average of that ratio. Usually when it does that, it indicates that the trend is strengthening. And also, something interesting to note is that when the S&P outperforms gold or vice versa, the trend tends to be in place for several years at a time. Speaking of the S&P, it also demonstrates some weakening leadership. In fact, weakening breadth is what's referred to in market jargon. Basically, if we look at the S&P 500 index and we compare that to the S&P 500 equal weight, which represents the average company in the index, we can see that although on the surface it looks like the S&P is having a pretty good return so far this year, the average stock is not doing as well. In fact, it's barely positive for the year. So what are we doing to position for what we believe is ahead and the weakness that we expect to persist? Well, we are positioning a little bit more defensively in our portfolios. We have an overweight in sectors like healthcare and staples, which are expected to do better on relative basis. And then we also have an underweight in financials and industrials, which are expected to not do as well in a weakening economic environment. And of course, we know what happened in the financial industry already, and we expect for this to persist in the future. Now, we're also favoring companies that demonstrate high financial strength and strong profitability, and also are avoiding those that have earnings variability and high financial leverage, as those are expected to do better in a cyclical upturn. Now, we talked about the weakness underneath the surface for the S&P 500 or US stock markets overall, but this is not necessarily true internationally. Here, we look at the percent of stocks within an index that trade above the 200-day moving average. This is accepted as universally as stocks being in an uptrend. And we can see the international markets are looking stronger on that measure. And that also is reflected in the relative performance compared to US markets. Now, for the last year, a little bit over a year, we've had international markets outperform the US. And similarly to the dynamic with gold, when the US outperforms internationals and vice versa, that trend tends to be long-lasting as well. In fact, the preceding period of the S&P vastly outperforming in the span of 14 years is the one that is outside of the normal for this ratio. So we believe that this is quite supportive for our allocation and our exposure to international markets.
Well, it's certainly a tricky environment. There are lots of cross currents and rough waters that we're going to have to deal with, but we do see a path forward if we take the measures that we have in place. We do think that we can navigate this environment by having a little bit of excess cash, by having an overweight in things like gold and being more defensive on the equity side. But it will be a difficult time, and as more economic clarity comes to pass, then we'll make adjustments as necessary. Well, if we want to wrap there, that's all we have for you today, but we do want to direct you to our website where we're producing a lot of other content, everything from the weekly newsletter, the Fact Pack, to a variety of other videos and information. So check it out, and if you have any questions, you know where to find us, and we'll see you next time.